right. Welcome, everyone, to another deep dive. Today, we're diving into something I know a lot of you have been curious about, investment portfolios. You've given us some pretty fascinating material to unpack, and I think we can go beyond just the basics. I'm really excited for this one. Plus, I have a pretty interesting question at the end that'll hopefully keep you thinking even after we're done here.
I'm excited too. Let's jump in.
Okay, so you've talked about wanting to buy a house in, say, 5 years. How does building an investment portfolio even factor into that kind of goal?
Well, a portfolio can really help you grow your money much faster than just, say, stashing it in a savings account. It's like your savings have a job. They're out there working hard, generating more money through investments.
I love that, giving your savings a job. So it's more than just getting rich quick, but it's like strategically growing what you've already saved to actually reach a specific goal, like a down payment.
Exactly. And that's what all our sources really stress is that first step, like setting those crystal clear financial goals. You can't just say, I want to buy a house. You need to get specific. What's the down payment going to be? When do you actually want to buy? That clarity is what really shapes your investment strategy.
It's interesting you say that because one source even brings up loss aversion. That psychological thing where we, as humans, feel the pain of a loss way more strongly than the pleasure of a gain.
It's true.
So having that super clear goal, that why behind everything you're doing, can really keep you grounded and focused and not making emotional decisions when the market takes a dip.
Absolutely. Being self-aware, recognizing those biases is super important. And it really all ties into that next concept that our sources emphasize, risk tolerance.
Okay, gotta admit, risk tolerance, the phrase itself, sounds kind of scary, like roller coaster level scary, exciting for some, terrifying for others.
Love that analogy. It's about how much up and down in your portfolio you can really stomach without panicking. And it really varies for everybody, right? It depends on things like your age, how much you're earning, how long you're actually investing for.
So if my goal is that house in 5 years, my tolerance might be way lower than someone investing for, say, retirement. That's decades away.
Right. And this all leads into the big one, asset allocation.
Okay, break it down for me. It's got to be more nuanced than picking stocks and bonds randomly.
For sure. Think of it like a puzzle. Each piece, or in this case, asset class, is key to building that full picture, which is your portfolio.
So we've got stocks, maybe some real estate, bonds for stability. How do we know which pieces we need and how much of each?
Well, that's where your goals, that risk tolerance we were just talking about, your time horizon, all come into play. And one source even suggests looking into things like target date funds. They basically adjust automatically based on when you want to retire. It's like your portfolio is on autopilot.
So target date funds, those are good for hands-off investors. But if someone wants to be more involved, how do you actually choose specific investments within each of those puzzle pieces?
Okay, so let's say you're looking at stocks. You could go for individual company shares, like you could literally buy a little piece of Apple or Tesla, or you could look into exchange-traded funds. We call them ETFs for short. They're basically baskets of stocks that track, say, the S&P 500. It's like you're getting a slice of the entire market.
Gotcha. And what about bonds? Are all bonds the same?
Not really. You've got the government bonds, usually seen as safer, but the returns aren't as high. And then you've got corporate bonds. Those are issued by companies, usually a bit riskier, but the returns could be higher.
This is where that don't put all your eggs in one basket idea comes in, right? Diversifying. And actually, our sources went deeper than that. One even talked about factor investing. You're looking at specific characteristics like, is the company a big one or a smaller one? What's their growth potential?
Right. That's a whole other layer of things.
It sounded kind of complex, to be honest.
Yeah, it can be, but the whole spreading your risk idea is at the core of it. It's just that factor investing adds another layer of, diversification. But remember, higher potential returns can also mean higher risk. It's all connected.
All right, so we've got the portfolio. It's diversified. Are we done? Can we just kick back and relax?
Not so fast. Investing's not just set it and forget it. Markets shift constantly, so keeping an eye on your portfolio and rebalancing, super important. Think of your asset allocation as a recipe. Over time, some of those ingredients, they might get too big, Rebalancing is like adjusting that recipe so you get that balance you initially wanted.
Makes sense. You're actively maintaining the right mix based on your original strategy.
Speaking of things that need to be managed, one source talked a lot about fees. What's the deal with those? Oh, yeah, they can be sneaky. You've got expense ratios. Those are for your mutual funds and ETFs, transaction costs every time you buy or sell. And then if you're working with an advisor, you've got advisory fees. They can seem small, but trust me, they make a big difference over time. You got to know what you're paying and why.
I really didn't realize how big of a difference those fees could make. Definitely makes you want to research carefully.
Yeah.
Okay, now let's say you're feeling a little lost, like you're in this investment jungle. The sources talk about staying informed, maybe even seeking help. What are your thoughts on that?
It's a never-ending learning process, this investment world. That's why those good financial websites, books, podcasts, those are all great ways to stay in the loop. And hey, if you're ever in a tricky situation or you just want some personalized guidance, there's no shame in talking to a financial advisor.
All right, so today we covered a Milanti, setting goals, understanding your own risk tolerance, figuring out asset allocation and why diversification is so important. We even talked about rebalancing and those pesky fees. It still feels like we've only just scratched the surface.
We did, but you've got the basics, the framework to start building that portfolio.
Mhm.
And remember, investing, it's a journey. It's not about reaching some final destination.
I like that. And it leads me to that question I wanted to ask you. You've got the tools now, so this week, what's one concrete action you're going to take? Will you figure out your risk tolerance, research some investments, or maybe you'll even reach out to a financial advisor? Even small steps can lead to big changes, you know?
That's a great thought to leave everyone with. Thanks for joining us for this deep dive.